Hey, Think Realty, thanks so much for joining us today on the podcast. I'm Eddie Wilson. Founded this company in 2013 because I'm a third generation real estate investor, and I wanted to take the conversations that happen around the dinner table with my dad and my grandpa all the way to the marketplace, because I was so blessed to be able to be taught real estate investing and all the benefits. Therefore, I started this in 2013, and now I get to bring all of my friends and the people I do deals with to the table to help guide you on your real estate investing journey. But first of all, I want to say a quick thank you to our podcast sponsor, which is Real Property Management. Working with the right property management company can put more money in your pocket, not less. Real Property Management provides a higher standard of property management to make sure you're maximizing the return on your investments. Experience the real difference with Real Property Management. Visit realpropertymgt.com. That's realpropertymgt.com. I've actually got two guests, two for the price of one today. We got Bill and Jonathan. Thanks so much for joining us, guys.
Oh, thank you so much. And I love that intro that you get to bring your friends and the people that you do business with, and then you ask people like us as well.
And, I won't even go into that. I'll just leave all that alone. But obviously, if you have been to any of our shows, you've probably seen Bill, probably Jonathan around. Also, Bill's sister, Wendy Sweet, you've probably seen in our ecosystem quite a bit there with Carolina Capital, and appreciate everything you guys do for the marketplace and our industry.
Sure. Yeah, well, what we enjoy most, other than also making a living, is educating people, and that really brings the most joy to us. I know each one of us love teaching because we want everybody to be successful around us, because if they're successful, then we all become successful.
Yeah, it's really, really good. So let's talk about the market. We don't have a long time on the podcast today, and I want to jump right in. Everybody's waiting for this impending interest rate drop, and it just never seems to come, right? How silly is it? Or maybe not silly. Maybe that's a little bit. Maybe that's a little rough. How unsophisticated of us is it to chase a real estate deal based on interest rate, right? Like, is the interest rate ever going to drop? Who knows? But what's your thought about that? Should we be waiting to get into the game based on interest rates?
Absolutely not. You shouldn't wait. I mean, what's that saying? You marry the house and date the interest rate. Like, buying. If you want to build wealth, and you have to do it now. Mm-hmm. And if you wait for interest rates to drop, I mean, what was it in the 70s? It took 21 years before interest rates dropped from the 70s to the 90s. You would have waited 21 years, and in that time frame, real estate appreciated threefold. So you don't wait.
Yeah.
Well, the way it works, there's always ways to make a deal work. Sometimes the deal doesn't work. It doesn't pencil out. It's not a deal anyway, no matter what the interest rates are. I bought my first house in 1978. The FHA rate was 14.5%. The way to invest in real estate at that point was to do, now mine was a FHA non-assumable or non-qualifying assumable loan. Mm-hmm. So if you had gotten one, say, 5 or 10 years earlier than that, the interest rates were much lower, so you just assume the loan and buy it that way. Mm-hmm. And then eventually rates would start coming down, but they went up quite a bit after mine. I mean, they were up to 18, 19% at one point. People were still buying real estate, though.
Yeah. And I think we're in a just like, it feels weird to a lot of people because we just exited, in the history of mankind, in our written history, the lowest interest rates ever. We have just exited that period, and there is an adjustment period. Like, there was sticker shock and still is sticker shock to a lot of people.
Yeah, and I think what it is it's a lot of people that are wanting to move. You got baby boomers who are trying to exit their houses, but they don't want to sell because their interest rate is so low. And it's just like, I think a lot of people are just holding in because they think, well, maybe if I wait. But the problem is like when you wait, even if you're just a retail real estate, or if you're a retail buyer, right? It's like waiting still prevents all of the equity that could be built in the property. You're missing all the appreciation, right? You're missing the real value of real estate. And I just feel like it's a fool's errand. I hear so many people preach rate, and to me, it's like, well, I mean, if you can, like you said, Bill, make the numbers work, then if the rate does drop, you're better for it, right? Like all of a sudden now you've got opportunity because most likely when an interest rate drops, housing values go up, right? So you're capturing the value, the appreciation of it. And also you can always refi, right? Like the whole date the rate thing. I mean, just if at some point, if there's enough disparity in what you're paying and what's on the market, you can always refi.
Well, if I can steal something from our friend Aaron Chapman, he looks at a fixed 30-year mortgage rate. It doesn't really matter. You're still making payments based on a dollar that's going to go down in value on an asset that's going up in value. So at some point, you're going to get much more value out of that because of the dollar is going to continue to go down in value, no matter what.
If you're like me and you buy and you hold everything and rarely ever sell anything, you're not the one paying the interest rate anyways, right? Like my tenant typically is, right? And as long as I put a fair, solid asset out in the marketplace that is, at fair market rate, right? There's a good product, then it's a win-win for everyone, right? And so, let me ask you another quick question, which to me is the one that I think is on the mind of a lot of people, especially when this podcast airs, is that we're in this election cycle, right? And we're moving into this election cycle, and there's always change during an election cycle. We actually know in the last 4 election cycles, the interest rates have actually dropped slightly. Who knows if it will this time or not? But what should a real estate investor be prepared for in an election cycle? People are typically sitting on their hands. They're typically not moving very quickly. They're waiting for change. What can someone do to capitalize on that marketplace?
Well, in my opinion, headlines are going to be driving most of the markets right now because of that, because people are sitting on their hands and they're waiting. So any kind of bad news is a good time to get in because that's when people are at their most vulnerable. Personally, I think rates are going to stay high for a while because inflation is going to remain sticky for a while, and it all comes down to energy prices. And as long as we keep creating higher cost energy, we're going to continue to have inflation. Things are going to cost more. So get used to this as a norm and don't let it bother you. Just continue to look for good deals. Prices, and here's part of the dilemma on single family right now. Home prices have not come down in most markets. They continue to go up because we have a single family home shortage, as you were saying earlier. The baby boomers don't want to get rid of the homes. So there's not a lot of existing inventory out there, and builders are not keeping up with the household formations. We're like 6 million homes nationally behind where we should be for new household formations. And then municipalities are making it tougher to build. They want to push everybody into a condensed area because it's cheaper for them to provide services. So it's going to be a while, and home prices are not going to come down. Don't be afraid of that. Because that means your investment is going to hold for a lot longer. That's the good and the bad about our current market. Don't stop investing. Continue to do so. Don't be afraid.
Is there a perfect asset class right now? It's like there's seemingly some that are good and some that are bad. Is there something right now that you feel is a really, really good, solid bet?
Well, I'll start it with office is not something that we would currently look into, and if you are looking into office, please tread lightly. That's a tough asset class to be in right now. For us, we're focusing primarily on 3 asset classes, and that is the formation of new single-family homes, so new construction single-family. We are also focusing on light industrial. And also self-storage. Those are the 3 that, for us, make the most sense right now.
Actually, there's one more. We like retail strip centers.
Yes.
You keep hearing, and I love this talk about brick and mortar retail is dead. I love that because it makes this worth less money to a lot of people.
Yeah.
But those are recession-resistant type properties. You don't have the Amazon effect with the retail strip centers. Amazon can't deliver you hot coffee. They can't cut your hair, do your nails, do your taxes. These are businesses that are very recession resistant and they're needed in the neighborhood. And as we all know this, and I say this all the time, self-storage, we have an unhealthy relationship with our junk, and that business is going to be around a while.
Yeah, and self-storage is just super hyper local. I mean, you're talking 1 to 3 mile saturation area, so it's really tight.
Yeah.
The other thing, I'm sorry.
No, I think self-storage right now is often being overlooked. I think we know that there are millions of baby boomers. There's 15 million baby boomers right now that own their own business that'll they get rid of their business, but not only that, will actually move and downsize out of their house. What happens with sentimental people, right? That unhealthy relationship with their junk is it's going to go somewhere, and they're going to go from a 2,000 square foot house to a 12,000, or 2,000 square foot house to a 1,200 square foot condo, and they've still got 2,000 square feet of junk, right? Like probably got like 25. If they've lived there a long time, it's 2,500 square foot of junk, right? Packed into little small spaces. But it's like I love the self-storage angle, and I think self-storage is going to continue to increase for a long period of time.
Yeah, and a lot of it's owned by small mom and pop investors that, it's been their business. Just like we talk about the retail centers with the tax shops and other things, like there's a ton of baby boomers not only downsizing, but they're also retiring and they're shuttering their businesses, whether they're self-storage businesses, tax offices, what have you, and they're just closing them. And those are good opportunities to get into as well. So we like that.
I was going to mention the light industrial is a good play right now because of the Amazon effect. Warehouse space is hard to find right now because of e-commerce, and the businesses that needed warehouse space prior to e-commerce still need warehouse space. So we have a shortage of warehouse space. You get over to the East Coast, there's more of a shortage there. We're onshoring more of product or offshoring it from China, and they're moving it to India, Vietnam, those areas. And they're bringing in freight to the East Coast of the United States, not to the West Coast of the United States. So all these ports along the East Coast are going to be a great opportunity going forward, and light industrial is really the way to invest in that.
Yeah, that's really great. That's the first time I've been shooting quite a few podcasts today, and that's the first time people have talked about light industrial, but I completely agree. I've had a couple of businesses that have really exploded, gone well this past year and a half. And to me, the two hardest things that I had to find, I just relocated my entire private equity firm to Northeast Florida, right? And a bunch of businesses, a bunch of people. We didn't really struggle to find housing, right? It's always, there was enough housing that it kind of like allowed us to relocate all of our employees. Small warehouse space for all of our AV team and all of our trucking and all that type of stuff, really difficult to find, right? Like, and it's a port city. Jacksonville has a port in it, right? Like, and it was impossible to find. Also, Class A office in the suburbs was really hard to find. You can go downtown Jacksonville and find all of it you want, right? Suburbs, really tough. Third, we've been expanding a coffee business, right? Like we're scaling our coffee company. Really hard to find retail space for coffee, right? Like, I mean, really difficult. It's just not there. So I think you hit on two of the three there, very specifically. And obviously office has still got a ways to go, but it's like two of those, those strip centers are really hard to find, occupancy in. And so I love that. So interest rates aren't really a factor. We've got a couple of asset classes that make a lot of sense. Let's talk about the fund that you guys manage. Because I know we've got kind of two audiences that we're serving. We have the active guy that's out looking for deals, underwriting, doing deals himself still. And then we got a lot of people in our space that are passively investing, who are trying to get to retirement to the best of their ability. Stock market has kind of overperformed, but now they're kind of terrified because if you got a 20% gain in the stock market, it's like, where's that stock market going to go, right? And they haven't realized their gains. It's just on paper. Their 401ks have not performed very well the last 3 years, right? And so you got a lot of people out there trying to get to retirement, but they don't have enough time to go out there and actively invest. They're just passive investors, and they're looking for alternative asset classes. Can you guys speak to maybe the strength of investing in the fund, and also, what type of fund you guys have?
Sure. So we have two Regulation D funds. The main fund that we started 10 years ago is an equity-only participation. So they are going to participate in the business of loaning money. So you're going to get essentially a piece of the profit every quarter. So you, as an investor, you own a piece of the business. What I love about that fund is if you're in it for growth, you're able to compound every quarter. So a quick example, if you had a $300,000 note at 11%, for 6 years, you would make $180,000 on that $300,000. If you are compounding at 8.5%, you make 200 and almost 24, 223, something, just at 8.5%. And it's funny how people don't realize how fortunate you are to have compounding. It's the eighth wonder of the world.
Sure is.
But you can easily take a $300,000 investment and over 20 years turn it into $1.9 million at just 8.5% compounding. It's so simple. The debt fund that we have, the other fund that we started, this is for folks that are accredited and aren't accredited. It's for folks that want to have a guaranteed monthly payment. So it's a note fund. We have 3 terms. It's a 1 year, a 3 year, and a 5 year term. So this is for people that want monthly income and also aren't accredited and can still get into it. We used to sell notes to people, and what I hate about notes is that I don't like people investing a chunk of change into one individual asset.
What we had was, we invest in a lot of notes because it's a numbers game. Just like buying real estate, you buy 100 homes and a couple are not going to be performing how you think. Same thing with notes. You have 100 notes, a couple of them are not going to perform how you think. You just do one note, you're gambling that could be the 1 or 2 in the 100 that could be the bad one. Mm-hmm. So that's what we try to avoid, and that's why we created this new note fund to, instead of people just buying and putting their entire retirement into one note, they can put it into a note fund that's diversified against dozens or hundreds of notes. So that was the thought process.
Yeah, and by the way, we don't want people putting their entire retirement account into our fund.
No, that was an example. Yeah.
You don't want that kind of responsibility. But to that point, investing in the banking side of things is the most efficient and I think the safest way to invest in real estate, because you control the asset as the bank without being responsible for it. Mm-hmm. When you're investing in a property or you're making loans on a property, you're at 70% max loan to value on it. So as the owner of the property, you have 100% investment into that property. But as the bank, you're only into it for 50 to 70% of the value. So you should have plenty of cushion. And again, you don't have all the hassles of actually owning it. Now, there's also downsides to that. You don't get the tax breaks that the government gives you for owning property. Sure. But if you invest in a tax deferred or tax exempt type of an account, that makes up for it.
Right. Yeah. If you maybe out of your self-directed IRA or something like that.
Exactly.
Very good. So how can they find out more about you guys and learn more about what you guys do at Carolina Capital? Okay.
So we have actually 3 easy ways or 4 easy ways. So carolinahardmoney.com, that's our lending side. And it's a nice website. We have carolina.fund for our investing side of things. Okay. And then my email address is bill@chmlending.net and then jonathan@chmlending.net.
Very good. Any last pieces of advice before we jump off of here for maybe a real estate investor that is maybe nervous about where the marketplace is, right? Just sitting there thinking about, next steps. Any just last pieces of advice for them?
I guess my advice would be, certainty and uncertainty are just feelings, and it really comes down to, as Bill said before, it's about the numbers. Don't look at interest rates. Don't look at all the noise around you. Look at the numbers. Look at, does this pencil out? Does this investment work? Is there upside? And if the answer is yes, do it. Because, like we know, real estate keeps appreciating in value.
And for me, I think you always need to keep as many exit strategies as possible available to you on any investment. So don't over leverage anything. Make sure that you're investing in properties that have more than one way to get out of it if you need to, because Murphy's Law is always going to come in effect if you only have one way out. And in order to stay liquid in this business, you need to have lots of options available. And the last thing is get a mentor. Go to your local RIAs if you're nervous and new. Find someone who's been around and has done it before. They're happy to share. It's always better when you're networking with other like-minded people.
Yeah, very cool. I appreciate you guys. Hey, Bill, real quick before we go, what's that new book you just released? Can I give a quick plug for the book?
Yes, it's called the the Drive.
He doesn't know something.
The Drive to Success. I've only had it for like a year and a half, and the first time you announced on stage that I had a book, I couldn't remember the damn name of it either. That's why you did it. So if you go to billfairman.com, it'll be flashing right in front of your face, and you can go to Amazon and get it.
I've actually heard great things about your book. You know, that's the second time I've called you out, and you didn't know the name of your own book. The first time it was from a stage. I was like, hey, Bill, what's the name of your book? And you did this exact same thing. I've been waiting all podcast. I've been waiting all podcast for that moment.
By the way, some people have asked me what my name was, and I froze.
Jonathan,
so what happens when you get old?
Jonathan, get him a name tag, all right? And on the bottom of that name tag, go ahead and put the name of his book, okay?
Absolutely.
All right, I appreciate you guys. Thanks for everything you guys do.
Thank you.
Take care. One last quick thank you to our podcast sponsor, which is Real Property Management. Working with the right property management company can put more money in your pocket, not less. Real Property Management provides a higher standard of property management to make sure you're maximizing the return on your investments. Experience the real difference with Real Property Management. Visit realpropertymgt.com. That's realpropertymgt.com. Before I wrap up the podcast, I want to make sure you're aware of the Orlando, Florida, September 12th and 13th Expo. We've never been to Orlando before. We've been to Tampa, and we had a great event just recently in Phoenix. And I want you to make sure that you come out to that. It's going to be a great show. Lots of great people coming out. Lots of great content. We're going to bring a ton of money out there. Some deals. It's going to be great. Don't miss your chance to learn, network, and make deals with some of the biggest names in real estate investing. For a limited time, receive a buy one, get one deal on tickets. If you go to our website, register for 2 tickets and enter the word podcast for the code, it'll give you the buy one, get one free. You'll get the special pricing. You can visit thinkrealty.com/Orlando to learn more about that. And we'll see you guys soon. Have a great day.